All right, so we're back for this month's investment committee webinar. Today, we want to give you guys a bit of a market update, cover some recent news stories that we've seen over the last month. And then we have our guest, Christian Wigley, who is the owner of Outsource My IT. And he is a cybersecurity expert that will be talking a bit about cybersecurity in today's landscape and how people and business owners can be prepared for the threats that are out there. So we want to start by just giving a review of the market vitals. So far in 2025, the S&P 500 is up about 4%. So coming off a strong year in 2024, where we saw the S&P up 25%, we've just continued to see that strength. Looking at some of those major indices, the S&P up 4%. We look at the NASDAQ and the Dow Jones. They had really strong months looking 1 month back now. So the NASDAQ up about 5%, Dow Jones up about 5% in the last month. And the Russell 2000, which is that small cap index, has lagged a bit so far to start off the year. Brandon, what have we seen in terms of international stocks so far this year?
Yeah, I think the international is an interesting point to bring up. Leading the way both year to date and then also in the past 1 month, returning 6%. I think if you were to maybe just look at the news and the headlines, you might not expect that. But when you're looking at, countries like China, Germany, and Spain, who have all done, really well and have outperformed the S&P. I think that lays a hand into the international, and especially, if you're looking at China with AI and innovation and the whole DeepSeek thing that came out a couple of weeks ago. That really causing a rally behind some of the, stocks in China. If you look at Alibaba, who's up about 20%. So I think those are all, interesting points to kind of look at of reasons why international has kind of outperformed, even
Yep.
though when you look at the news, and we'll kind of go into this a little bit later about, tariffs, and then also, some inflation in the United States as well.
Yeah, it was interesting because after the election, international got crushed over the next 2 months. And we've seen it rebound back here to start off 2025. Seems like that initial reaction after the election could have been a bit of an overreaction based on what we're seeing in the last 2 months in international.
I think
Uh,
there's one big thing here that I think really stands out, and this kind of goes to something we were asked about going into this year by a lot of clients on calls. A lot of people were like, "What do you think about next year? Like, what do you think is going to happen? Is it going to be a good year or not so good year?" And one of the responses we had at the time was, kind of give us the first 2 weeks. When we have a good January, the possibility of it being a strong year increases a lot. And so here we are, 1 month in, and if the market was basically to annualize the performance that we've seen so far, it would be an over 30% year. So do we think that's going to happen? No. But it is worth noting that this year has been very strong across the board. S&P up 4, NASDAQ up 5, Dow up 5, Russell up 2.3, international stock market up 6.4. These are great numbers. So really, really good numbers. And it hasn't been uh, it hasn't been a perfect news headline year so far. So there's been a lot of reasons for investors to get queasy, for this market to be shaky, but it hasn't. It's been pretty rock solid all the way through. And so I think as people see the headlines, as people get, feel one way or the other, they should kind of take a minute and reflect on the fact that the market has kind of just barreled right through anything that could have been perceived as negative.
yep. DeepSeek came out on January 17th. That's about a month ago from today. You look at the NASDAQ, it's up 5% in the last month. So a lot of those companies like NVIDIA, technology, semiconductor companies that you think would be hurt by that DeepSeek information just rebounded right back after that first couple of days of pain. So it's definitely been a strong start to the year.
Well, even just this week, the European Union decided to announce a $200 billion um, program for artificial intelligence in Europe. This is a thing that's, not going away. They're throwing real big numbers at it.
Yep. Looking at Bitcoin, it's at about 96,000 right now. 2024, it had a explosive year, up 117%. So far this year, not as explosive, up about 3%. It's been kind of stagnant, trading in that range of 92 to 105,000. So we haven't really seen a big breakout or breakdown from Bitcoin thus far. It's something that we're going to be continuing to monitor after that explosive year that we saw in 2024. But Brandon, what have we seen in terms of some of the other sectors in the market so far this year and in the last month?
Yeah, I think the sector is just another important thing to take note of. What's kind of been doing well, leading the charge, and then also, what's lagging behind a bit. Financials have continued to do well. If you look at, XLC communication services, that's, really outperformed, especially if you're looking at some of their holdings, like Netflix and Facebook Meta. You can kind of see technology being middle of the road in that aspect. And then consumer discretionary, lagging behind a bit, with a heavy allocation to both Tesla and Amazon. So I think it's really, noting one, what sectors are kind of doing well, and then also a little bit about what are the driving factors behind it, taking a little bit deeper dive,
Mhm.
and being and recognizing in what's continuing to drive the market. Is there an opportunity in one sector, or how is it, kind of been performing since the start of the year?
Yep. Awesome. Looking at some of the recent news stories we've seen over the last month, this is one we touch on a lot, but inflation has been a big topic in the market. Is it back on the rise? The most recent CPI print that we saw was 3%. Looking back to August of 2024, that CPI number was more like 2.5%. So we've seen that inflation start to tick up again a little bit. And what are some of those factors leading to both hotter inflation now and the fear of potentially hotter inflation in the future? So I think there's a few things to point to. Tariffs being one of them. I think that's more of a future inflation thing because that's not really baked into the numbers that we're seeing now. But there's been so much news about tariffs and updates coming through. It can be hard to kind of track what's happened so far. So just wanted to give you guys a bit of an update of what has actually transpired. The tariffs that were put on Mexico and Canada have been paused for 30 days. We did enact a 10% tariff on China. We put tariffs on imports such as steel, and we might be getting tariffs on other specific goods like foreign cars, pharmaceuticals, semiconductors. And most recently, Trump has really emphasized the idea of reciprocal tariffs, which is going to be placing tariffs on countries that have tariffs on us. So that's a little bit of an overview of what's happened so far in terms of the tariffs, because there's just so much to sift through in the news every day regarding this topic. If we look at more short term, what's actually affecting the numbers today, bird flu and egg prices. So bird flu has affected the health of chickens and the health of eggs, which has raised the price of eggs in the last month by 15%. So that's an upward pushing factor on that inflation print. If you also look at real estate and insurance, those are two factors that are baked into that CPI a bit that have not really calmed down. The real estate market continues to be hot. Looking at insurance, like auto insurance over the last 1 year, it's up about 12% over the last year. So those are a couple other factors in that inflation number that have led to that tick up from 2.5% in August to 3% that we saw in January. What do you guys think are some of the impacts on interest rate policy from some of these inflation numbers that we've been seeing?
Yeah, I mean, along with that, I think something with the, tariffs real quick too is, kind of an important distinguish between what's almost being presented at the beginning and then also, what comes to fruition later on, and
Yeah.
seeing back and forth. And, it's hard to sift through all of the news on it, but, I think it is important to not necessarily, react off the initial, but, figure out what is actually, being proposed and what actually happens. And then you can make a more educated decision based off of that, of what has the biggest effect, or, what may not be as affected as, the initial proposed plan.
Yeah.
I mean, if you're Jerome Powell and you spent all of last year looking at inflation coming down, 2023 inflation coming down, you cut rates, you've been telling the market, that we want to be transparent and that we see things all moving in the right direction. You really had the past 5 or 6 months of inflation data being low enough to say you've kind of done what you came here to do, but it's not at your target rate. You're not at 2%, which is your target. So it's really hard for the Federal Reserve to, keep coming out and saying that they've been victorious and they've done all that they needed to do. But the data is not moving directionally enough for them to change course and, look like they made a policy error in cutting too much too early. They've already got some egg on their face on potential policy errors in the past. I think that they are kind of sitting right on this. We could cut, we could raise here, and I could make an argument for either one. But I think that they are going to be reticent to want to raise in the face of, looking like they made a policy error in cutting too soon, which I know some critics have been kind of saying. So either way, higher inflation, potentially, data that starts moving in the wrong direction. It just makes a lot more question marks for what the Fed's going to do for market participants. It just gives you one more reason to be a little bit more cautious and keep your eyes peeled.
Yep, definitely. The second news story we want to take a look at is just Q1 earnings so far for the S&P 500, what some of our takeaways are. So looking at Q4 of 2024, we've actually had the highest growth rate since Q4 of 2021 in terms of earnings growth. It was about 17% looking over the last year for earnings growth of S&P 500 companies. So pretty healthy in terms of the growth that those companies are seeing. When we look at the current price to earnings ratio of the S&P 500 in total, it's at about 22.2, which just gives you an idea of like the valuation of the market right now. Looking at the 5-year average of about 19.8 and the 10-year average of 18.3, valuations are a bit elevated right now, that 22 number. So it's looking a bit hot when you take into consideration those historical averages. One other interesting thing about these earnings calls, there's a lot of mention of these tariffs. There was the highest number of S&P 500 companies mentioning tariffs while they talk about their guidance since Q2 of 2019. A lot of materials, utilities, energy, industrial sector companies are mentioning these tariffs. So it'll be interesting to see as we move forward how these tariffs will affect the earnings of these sectors specifically and all the companies that make up those sectors. And lastly, just looking at the reaction we've seen to earnings so far compared to historical averages, the market is rewarding positive surprises in earnings less than average, and they're punishing negative surprises a bit more than average. So I think this goes a little bit towards that valuation point. Since valuations are so high, expectations for these companies are very high. Even when there's outperformance or a surprise in the earnings, they're not seeing the same kind of positive reaction that we might have seen in the past when valuations are lower. So it's just something to be a bit cautious of as we move forward in this hot market that we've seen do so well over the last few years.
Yeah, I mean, I think that goes back to a point that we brought up, multiple times before too, of kind of looking at what's in your control versus out of your control. And while, earnings of the companies aren't necessarily in your control, the research and analysis is to a certain degree on that. So, looking at the sectors, have there been a lot of growth in companies in those? Is there a reason why they're kind of beating the expectations versus other sectors, or is there something fundamentally wrong with a certain company? Versus if you kind of look back at, the inflation and the tariffs, where that's more, reactionary based off of the news.
A lot of moving parts.
Yeah, so here we have a chart going over the history of the volatility index and how volatility leads to opportunity. So what does the VIX index measure? And it's really a gauge of how investors think the volatility of the stock market will be over the next 30 days. And if you look at the average closing price of it since 1991, it's been about 19. And over the last 2 years, we've seen it below the average of about 15 and then 16. And it really gives an indication of, being above the average or below the average of the market. So when it's above, there's a little more uncertainty into it, maybe a little more fear or, market sentiment of, defensive, where if it's below it, a little more calmer sentiment of markets steadily rising. So, it's really important to kind of look at it as an indication of are we seeing, future volatility come in? And even still, the VIX is about 15.6 right now. So it's still on that kind of averages over 2023 and 2024. But when you do see a spike, if you look at the chart in the bottom right where it does kind of go above those averages, if you look at 2022, you're seeing it above the average and even going up towards, 30 of kind of recognizing the opportunity of the market if there is a decline whether it's kind of short term or long term, one kind of positioning yourself and then also taking advantage of that. If you just look back at 2022 with the volatility and the decline, where are some of the bigger opportunities there, and focusing on tech and how that has done over the past, 2 years in 2023 and 2024. So it's kind of recognizing the decline or the volatility. Where are the opportunities? And similar to Sean's point on the last side of, the earnings, are they good quality companies? Do they still have the fundamentals behind them, even though there may have been a decline because of, the general volatility of the market or the sentiment of the market?
Yep. Yeah, I think those spikes just tend to be really good opportunities, not only for equities, but things like structured notes that we're pricing out. When we see those volatility spikes, we typically are getting better pricing on those types of investments. So those spikes are, even though they're scary and they mean that sentiment or that people are expecting more volatility, those tend to be the best times for opportunity and positioning your portfolio for future success.
Well, that's a good way that you just said there, Sean, is, Warren Buffett kind of famously says, be fearful when others are greedy and be greedy when others are fearful. And the VIX index, which is also sometimes, when you hear it on CNBC, is referred to as the fear index. The higher it is, the more fearful the investor world is. So if you look at the biggest spike around 80, was actually 86 was the high, I believe. That was during the financial crisis. You see the other biggest spike on there was COVID, when uncertainty is at its highest and when investors are looking for the exits at their craziest is when this thing spikes. And usually, as you said, Brandon, there's an average around 20. Um, if you're somewhere around that average, maybe it could go lower, maybe it could go higher. Tough to tell. But when it's at 80 or 40 or any number in that range, it tends to recede relatively quickly. And so this is a good way when you're feeling fearful and you're like, oh my God, is the world about to end? If you go to the VIX and you see it at one of these extreme levels, you're not alone. And you can also somewhat see that as maybe there's an opportunity here because maybe people aren't being fully rational. There's some emotion being priced out there that I can take advantage of. And that's why, we just want to keep people in mind as we go into this environment, which we were warning is likely to be more volatile as we have disruptive policy like tariffs or any kind of the trade policies which we're enacting, which are big shifts from where we have been. Volatility may spike. And instead of looking at it and saying, oh my God, what do we do? Let's consciously say, assume it spikes. What are we going to do? Well, if we look at this chart, it implies that when it hits extreme levels, that we should be looking at putting capital to work or increasing our risk because we think it might come back quickly. And again, this chart includes 2008, the financial crisis. Nobody knew what was going to happen. This includes COVID, the very early onsets when we had no idea where things were going to go. So that's just something to keep in context as we move forward, as we go through these things, as uncertainty comes out there. try to keep it in the context of that financial crisis, COVID, these things that led to great uncertainty. We didn't know where they were going to go. And let's kind of try to astral project ourselves there to think about what are we going to do next time? Because there will be a next time, not necessarily because of policies or anything else. We don't know what the next time is going to be, but we know that the behavioral pattern that we've seen in the past with the VIX and the markets has some rhyme to it because we're dealing still with humans and how they really don't like not knowing what comes next, and then how they react within financial markets to that, and whether or not that creates an opportunity or not.